Good afternoon, everybody. We have about 5 minutes before the webinar gets started. While you wait, you can go ahead and download the handouts. They are available in the Handouts tab. You can just click on that file and you can download it to your computer. We also have the questions box. If you have any questions for the presenter, you can go ahead and type those in. You can also connect using your computer audio, or you can call in to the phone line. The information for dialing in can be found on the audio tab. And again, you can take a moment to download those handouts. We'll get started in just a few minutes. While you wait, you can make sure your audio is connected. You can dial into the phone line, or you can listen through the computer speakers. You can choose which way you want to listen on the audio tab. We also have a handout that's available for you. It's a printout of the slides, so you can go ahead and download that now. You just click on that file and you can save it to your computer. Good afternoon, everyone. Thank you so much for joining us for today's GASB update. We have a couple announcements before we get started. We do have a handout that's available for you. It's a printout of the slides for today's presentation, so you can go ahead and take a moment to download that. You can locate the Handouts tab, just click the file, and you'll be able to save it to your computer. We do have a questions box, so if you have any questions throughout the presentation today, you can type it into the questions box there, and if we don't have time to get to it during the webinar, we'll try to get to it at the end. To earn CPE for today's webinar, you'll want to make sure to respond to the polling questions when they pop up on your screen. If you answer 3 or more polling questions, you will be awarded a CPE certificate that you'll get in about a week or 2 weeks through your email. And that's it for me. I'll go ahead and turn it over to our instructor.
Thank you, Morgan. Good afternoon, everyone, and welcome to Cherry Bekaert's 2019 GASB Update. My name is Brandy Grovac, and I will be your host today. I am a manager based out of our Orlando office, and I have been with Cherry Bekaert for almost 6 years now. As Morgan mentioned, there is a questions pod where you can submit questions throughout the webinar. But this is my first webinar for Cherry Bekaert, so I don't know if I'm going to be able to attend to questions while I'm presenting, but I encourage you to submit any questions you may have anyway. I will see if I can address any at the end of the webinar. Otherwise, I will definitely get back to you after the webinar via email. So we have 2 learning objectives for today's webinar. By the end of this webinar, you should be able to describe the accounting and financial reporting of recently issued GASB standards effective for the current and upcoming years, and be able to identify the projects currently being assessed by the GASB and the potential implications for governmental entities. Our course topics today will be on asset retirement obligations, debt disclosures, including direct borrowings and direct placements, fiduciary activities, majority equity interests, leases, interest costs incurred before the end of a construction period, and various exposure drafts and projects being assessed by the GASB. And we're going to go ahead and kick this off with a polling question right off the bat. So Morgan, could you display the polling question, please? Okay, so I am asking what type of governmental entity you represent: a state government, a public school or university, city, county, or town, other governmental entity, or other. Okay, give you guys just another couple of seconds here. Okay, it looks like everybody who wants to vote has voted. So Morgan, we can go ahead and close that out. It looks like we have quite a few city, counties, or towns, a few state government, and a lot of other, and a lot of public schools or universities. So we have quite the mix here. Okay, that's good. Okay, so our first topic today is going to be GASB 83 on asset retirement obligations, which was issued in November 2016. This statement will require us to recognize a liability if we have an ARO resulting from normal operation of an asset other than a landfill. So all landfills are excluded from this standard. And first we'll need to define what is an ARO. Statement 83 defines an asset retirement obligation as a legally enforceable liability associated with the retirement of a tangible capital asset, meaning we will have to pay money in order to retire that capital asset. And an example of assets that may have an ARO include an X-ray or an MRI machine. These are the types of assets that cannot be simply thrown out in the trash when it's time to dispose of them. They will need to be properly retired. This statement requires us to recognize a liability for the total cost of disposal of those assets and to recognize that cost over the life of the asset. So how do we recognize that liability? When the liability is recorded, the other side of the entry is going to be a deferred outflow of resources, which will then be expensed in a systematic and rational manner over the estimated useful life of the asset. By the time the asset has reached the end of its useful life, the deferred outflow should be zero, and we will have the balance of the liability for the retirement of the asset. The standard says that this liability should be recognized when both incurred and reasonably estimable. So a liability is considered to be incurred by the occurrence of both an external obligating event and an internal obligating event. An external obligating event includes things such as federal, state, or local laws and regulations, a legally binding contract, or issuance of a court judgment. An internal obligating event could be as simple as placing the asset into service or even purchasing an asset that already has an external obligating event attached to it. So in short, a liability is incurred when the government holds an asset that has a legal requirement for proper disposal. The measurement of the liability should be based on a best estimate of the cost of disposal. If there are multiple possible estimates, you should calculate an average estimate that is weighted by each estimate's probability of occurrence. If that option is not feasible, then you should use the most likely amount. And this estimate should be based in current dollars, meaning the cost that would be required to dispose of the asset today. The liability will be adjusted for inflation and other changes in estimate each year. The transition to apply this statement is required for reporting periods beginning after June 15, 2018. For our June and September year ends, that will be fiscal year 2019. The statement should be applied retroactively by restating the financial statements for all periods presented. Next in our discussion is GASB Statement 84, Fiduciary Activities. And this is one of the bigger standards I will be presenting today. And while the standard itself is not necessarily long, there are quite a few considerations to determine whether an activity is a fiduciary activity. We also anticipate that some governments could be significantly impacted by the implementation of this standard. Activities that were previously reported as fiduciary activities or agency funds may not actually be fiduciary activities under this standard and will need to be reported elsewhere. The same could occur in reverse. Activities that were not previously considered fiduciary activities may now meet the definition. The impact is really going to depend on how closely your current reporting is to the guidelines established in Statement 84. Now, the reporting of fiduciary activities has been a GASB concern for some time now, and I'm going to start with a brief history behind the statement. When GASB issued Statement 14 in 1991, it was the first time fiduciary fund activity was required to be presented in the financial statements. The statement indicated that these activities were to be included, quote, if the primary government has fiduciary responsibility for them. However, no guidance had been provided regarding the characteristics that should be considered in deciding whether a government has a fiduciary responsibility. As a result, governments have interpreted differently which activities should be reported as fiduciary activities, and governmental financial statements lacked comparability. The lack of guidance became an even bigger issue in 1994 when the GASB issued Statements 25 and 27, which were the original post-employment benefit standards. The GASB received numerous questions about whether particular post-employment benefit plans should be reported as fiduciary activities. It took until 2010 for the GASB to begin considering to include guidance on activities that should be reported as fiduciary funds in Statement 61, but ultimately they decided that Statement 61 wasn't the place to address fiduciary activities. At that time, fiduciary activities was added to the technical agenda, and in 2017, Statement 84 is finally issued. Now, this standard can be broken down into two parts. One, identifying fiduciary activities, and two, reporting fiduciary activities. So we're going to start with the steps to identify a fiduciary activity. So this flowchart is provided in Appendix C of the statement in three parts. One of our employees combined the three charts provided by the GASB into the single flowchart for ease of use. And we understand that on the slide here the contents aren't readable, but we're going to zoom in on the sections of this flowchart as we discuss them. I'd like to point out that this chart is not quite as daunting as it appears. These orange highlighted sections here are identical. We just have them presented separately for ease of flow. And there are other sections of this flow chart that are pretty repetitive. Lastly, I need to point out that although these charts do appear in the appendix of the standard, the GASB states that these charts are not authoritative. So you should refer to these charts in conjunction with the standard when trying to identify whether an activity should be reported as a fiduciary activity. We have identified 4 paths in this chart that lead to a fiduciary activity end result. Component units that do provide post-employment benefits, component units that do not provide post-employment benefits, post-employment benefit arrangements that are not component units, and all other activities. So you can see that component units is an important aspect in our decision, and post-employment benefits is also an important aspect. So first, component units that do provide post-employment benefits. This path outlined in orange is for the component units that do provide pension or OPEB benefits. And I just want to show you how one of these individual paths fit into the flow chart as a whole. We're not going to highlight each path like this. We are just going to zoom in. So these first 2 considerations here are inherent in the title of our path. The assets are held by a legally separate entity that meets the definition of a component unit, and the assets are held for pension or OPEB arrangements. We'll look at these next 2 together. The third consideration here asks whether the pension or OPEB plan is within the scope of other GASB guidance. Well, what other GASB guidance? And this is one of the reasons why the flowchart should be used in conjunction with the standard. I'll explain what they mean by this one in a moment. And this fourth consideration here asks whether the assets are from entities that are not part of the reporting entity being accumulated for pension or OPEB, not administered through trusts that meet the criteria of paragraph 3 of statements 67 and 74. So that one was much more specific, so much so that we couldn't fit it into the box. But in both cases here, a yes answer is going to lead to the conclusion that the activity is a fiduciary activity. And here's what they mean in those 2 boxes there. These first 2 bullet points belong to the third flowchart box, which asked whether the plan was within the scope of other GASB guidance. Statements 67 and 74 are the standards they were referring to, specifically those plans that are administered through trusts or equivalent arrangements as defined in paragraph 3 of those standards. The last bullet point relates to the fourth flowchart box, pension and OPEB plans that contain assets from entities not part of the reporting entity. These include pension plans subject to statement 73, OPEB plans subject to paragraph 59 of statement 74. And since we've all just survived the pension and OPEB standards, this fiduciary determination should be pretty easy. If the activity is a component unit post-employment plan accounted for under the standards we just identified here, then the activity is considered a fiduciary activity. Next, component units that do not provide post-employment benefits. And we can see the path for this scenario here. Again, these first 2 points along the path are inherent in the title of our path. The assets are held by a legally separate entity that meets the definition of a component unit, and the assets are not held for pension or OPEB arrangements. If an activity is not a post-employment benefit arrangement, then we have these next 3 considerations. 1, the assets are held in a trust or equivalent arrangement, and the government is not a beneficiary. 2, the assets are for the benefit of individuals, and the government does not have administrative or direct financial involvement. Or 3, the assets are for the benefit of organizations or other governments that are not part of the financial reporting entity. If the answer to any one of these 3 considerations is yes, then we have a fiduciary activity. And there are a couple of terms in here that could use some clarification, particularly in this box here. Administrative involvement, while not explicitly defined in the standard, the GASB did provide us with some examples. A government would have administrative involvement if the government monitors compliance with the requirements of the activity that are established by the government or by some other resource provider, if the government determines eligible expenditures that are established by the government or some other resource provider, or if the government has the ability to exercise discretion over how the assets are allocated. Direct financial involvement is also not explicitly defined, but we are provided a single example by the GASB. If a government provides matching resources for the activity, they are considered to have direct financial involvement. And it's important to remember that as these are only examples the GASB has provided us with, they may not be all inclusive or all exclusive of what could be considered administrative and direct financial involvement. So this is an area that may call for some judgment. So we've made it through two of the paths identifying fiduciary activities. If you're beginning to feel a little overwhelmed, don't worry. As I mentioned at the beginning, some of these are pretty repetitive. The first two paths we discussed were activities that are considered component units, and these next two are not component units. This next path, post-employment benefit arrangements that are not component units, is very similar to the first path we discussed, which was also for post-employment benefit arrangements. When an activity is not a component unit, and we answer no to this first question here, the next question is always going to be, does the government control the assets, or hold the assets, or have the ability to direct the use of the assets? If the activity is not a component unit and the government does not control the assets, then the activity is not related to the government and should not be reported. We should have an additional box right here that says no and not reported. However, if the government does control the assets, we continue down our path, which you will notice is the exact same as the first path we explored. If the assets are for pension and OPEB arrangements, accounted for under Statements 67, 74, or 73, as we previously described, then we do have a fiduciary activity. So you'll see the only difference between this path and the first path we looked at is that the activity is not a component unit, and then we had to determine whether the government controls the assets. And since control is such an important aspect here, let's define a little more what that means. A government is considered to have control of assets if the government holds the assets or has the ability to direct the use, exchange, or employment of the assets in a manner that provides benefits to the specified or intended beneficiaries. Now, a government's control of an asset is not affected by the presence of legal or other external restrictions. Governments already may control assets that are restricted, and control is also not affected by the appointment of a designee to act on the government's behalf. So hiring an administrator to collect, invest, or provide the assets to the beneficiaries does not negate the government's control. Lastly, we have the path for all other activities. And this is the largest of the paths, but it still incorporates several of the steps we've already seen along the way. The first three steps can be answered easily since we have already covered all other options related to these considerations. In this case, the activity is not a component unit. The government does control the assets, and the activity is not for pension or OPEB arrangements. Our next consideration on this path is whether the revenues are derived solely from the government's own source revenues. In other words, generated by the government itself. If the revenues are generated by the government itself, the activity would not be a fiduciary activity. If the revenues are not generated by the government itself, then we move on to these next two considerations. And these two questions here are included simply so that a government would not think pass-through grant revenue could be a fiduciary activity. If the revenues are from pass-through grants, they are not fiduciary activities. If the answer to these considerations is no, then we move on to these same three considerations we had in the second path we explored. Whether the assets are held in a trust or equivalent arrangement and the government is not a beneficiary. If the assets are for the benefit of individuals and the government does not have administrative or direct financial involvement. And whether the assets are for the benefit of organizations or other governments that are not part of the financial reporting entity. Again, if the answer to any one of these three is yes, the activity would be considered a fiduciary activity. And the GASB received quite a few questions to the exposure draft to clarify what are own source revenues. And this is the expanded definition that the GASB provided. Own source revenues include both exchange and exchange-like transactions, such as charges for services and investment income, and certain non-exchange revenues, such as derived tax revenue and imposed non-exchange revenues. It's not really practical for the GASB to attempt to define all types of revenue that should be considered own source, so this is another consideration that may require a little judgment. But I do think this definition gives us a good idea of the types of revenues the GASB is really intending us to consider here. And so that concludes identifying fiduciary activities. The second part to this standard is reporting fiduciary activities. All fiduciary activities will need to be reported in one of these 4 fiduciary fund types. And while there are 4 fund types listed here, I want to make it clear that these are not the same as the 4 paths of identification that we just talked about. So a path does not equal a fund type. Pension trust funds, whether they are a component unit or not, will be reported as pension trust funds. Investment trust funds will include the external portion of investment pools administered through a trust. Private purpose trust funds will include all other fiduciary activities administered through a trust. And custodial funds will include all other fiduciary activities not administered through a trust. An example of an activity that would be reported as a custodial fund is the external portion of investment pools not administered through a trust. So you'll see external portion of investment pools may be split depending on whether or not they are administered through a trust. Also, as a result of this standard, there will no longer be agency funds. Most activities currently considered agency funds will be included in the custodial funds category. However, you will still need to go through the identification process to make sure that they qualify as a fiduciary activity. Now, the standard does not only apply to governmental activities. Business type activities may also have fiduciary funds. And if they do, those activities will need to be reported separately in their own fiduciary fund statements. The GASB has provided us with an exception, which in this case may help simplify our reporting. If the assets are only expected to be held for 3 months or less, and they have corresponding liabilities, that activity may still be reported in the statement of net position. The transition to apply this statement is required for reporting periods beginning after December 15, 2018. For our June and September year ends, that's going to be fiscal year 2020. The statement should be applied retroactively by restating the financial statements for all periods presented. And I think I covered all the main points on this standard. However, if you want a little more detail or you just want to go through this a little slower, Cherry Bekaert has provided a full-length webinar specifically on GASB 84. You can access the recording on our website under the Guidance tab and through the On-Demand Recordings link. Recorded webinars do not qualify for CPE, but it is available for reference if you would like to use it. And if you still feel confused about whether your activities qualify as fiduciary activities or not, you should know that you are not alone. There is an exposure draft of the implementation guide for the standard available on the GASB website. The comment period has ended and the GASB is currently in the review process before issuing the final implementation guide. But if you look at that draft, you'll see it's loaded with questions, providing example scenarios and asking, is this an example of administrative involvement, financial involvement, control, etc.? And because of the nuances that may exist in your various government activities, I would rather that these not be the kinds of questions that you send in to me. I would recommend you ask your friendly Cherry Bekaert auditor, since they would be more familiar with your specific activities and circumstances than I would be. I presented this same webinar to our auditors yesterday, and I told them that they may need to be ready for your questions. So now that we've discussed Statement 84, we're going to ask, what impact do you think this statement will have on your entity? Major, some, minor, none, or I'm not sure yet. Remember, if you would like CPE, you must select one of the options so that no vote is no longer selected. Okay, and people are voting. We're up to about 88%. I'll give you guys a few more seconds here. Okay, and the numbers seem to have stopped climbing, so we'll go ahead and close out that poll there. It looks like the majority of people think that there will be some influence. Only 7% say major, so that's good. There's not a lot of people out there who think that this is going to seriously affect them. So we will see what happens when it comes to implementing. Okay, this next topic, GASB Statement 87 on leases, is our other big standard. So among the many changes in this standard, we will see that operating leases no longer exist, and the definition of a lease has changed. And because of that, we can expect this standard might also have a significant impact on governmental entities. Contracts that we previously identified as leases may no longer qualify under the new definition, and contracts that previously did not apply may now be considered leases. So governmental entities are going to have to do a thorough review of their contracts to determine which should be included as leases and which should be excluded. And then we will need to calculate the value of those leases under the new standard and record a restatement. So this could be quite the undertaking. We have until fiscal year 2021 to implement the standard, but if you haven't been giving it much thought, I do suggest you start soon. So as I just mentioned, the standard removes the concept of an operating lease, and all leases meeting the definition will be recorded as financing leases. Financing leases are accounted for similarly to our current capital leases, but there are changes to that which we'll discuss here. So what is this new definition of a lease? A lease is a contract that conveys control of the right to use another entity's non-financial asset, the underlying asset, as specified in a contract for a period of time in an exchange or exchange-like transaction. Again, we have a definition that needs clarification. So let's define what non-financial assets are. Non-financial assets are anything that does not meet the definition of a financial asset as provided in Statement 72. And in general terms, non-financial assets include items such as property, plant, and equipment, while financial assets include such things as cash, investments, receivables, and options. It's also important to note that the definition of a lease only applies to exchange or exchange-like transactions. Some government contracts transfer the right to use an asset for a nominal fee, such as $1 per year. Those contracts would be excluded from this statement because they are not exchange or exchange-like. And let's also further define control. To determine whether a contract conveys control of the right to use an underlying asset, the lessee needs to have both the right to obtain the present service capacity from the underlying asset and the right to determine the nature and manner of use of the asset. For example, a lessee would have control over a leased vehicle if they get to decide who drives the vehicle, when the vehicle gets driven, where the vehicle is driven, etc. And of course, the definition of a lease needs a couple of exceptions, or better yet, several exceptions. So remember how we said a non-financial asset is basically just property, plant, and equipment? Well, that excludes investment assets, such as rental properties, contracts that fall under other regulations, such as for airports or air carriers, service concession arrangements, which are still governed by GASB 60, intangible assets, such as software, biological assets, including timber or live plants and animals, inventory, and supply contracts, such as power purchase arrangements. Also excluded from the definition of leases are intra-entity leases, leases that are less than 1 year, or leases where the asset would be transferred to the lessee at the end of the contract. So now that we've defined what a lease is, let's look at how to account for them. And in the interest of time, and since it seems to be a little more common for governments to be lessees than lessors, we're going to focus more on the lessee accounting today. We will, however, still show a summary of a lessor accounting later on. Now, once that you've identified a contract meets the definition of a lease, the lessee is going to initially record a right of use asset and a liability for the present value of future lease payments. In subsequent years, the right to use asset will be amortized, typically using the straight line method, over the shorter of the lease term or the estimated useful life of the asset. The lease liability will be reduced over the years by the actual cash lease payments in very much the same manner as our current accounting for capital leases. Now, under this statement, the initial recording of the liability and the asset may not match, and we'll first need to measure the liability. The initial measurement of the lease liability should include fixed payments, variable payments that depend on an index or rate, or which are fixed in substance, amounts that are reasonably certain of being required to be paid by the lessee, the exercise price of a purchase option, if it's reasonably certain the lessee will exercise the option, payments for penalties for terminating the lease, if the lease term provides the lessee the option to terminate or includes a fiscal funding clause, and any incentives receivable from the lessor. Basically, any amounts that are reasonably certain of being required for the right to use that asset are included in the calculation of the lease liability. Amounts that should not be included are variable payments based on future performance by the lessee or variable payments based on usage of the underlying asset. And since the measurement of this liability should be at the present value of these payments, we also need to determine a discount rate and the lease term. The discount rate should be the interest rate charged by the lessor, which may or may not be implicit in the lease. And lessees are not required to apply the guidance for imputation of interest in Statement 62, but may do so as a means of determining the interest rate implicit in the lease. We may use the estimated incremental borrowing rate only if the interest rate cannot be determined. The lease term is another area of this standard that has changed significantly from current practice. While we have typically considered the lease term as the minimum required term, we are now going to use the maximum, which may involve some judgment. Under the new standard, the lease term is the period during which the lessee has a non-cancelable right to use the underlying asset. These non-cancelable periods include those periods where either the lessee or the lessor has an option to extend the lease if it's reasonably certain that the option will be exercised, or the option to terminate if it's reasonably certain the option will not be exercised. And these options are only included in the lease term if only one of the parties, the lessee or the lessor, has the option to renew or terminate. Periods during which both parties individually have the option to extend or terminate the lease, or if both parties have to agree to extend or terminate, are considered cancelable periods and would not be included in the calculation of the lease term. And since this will require some judgment about whether the lessee or the lessor will elect to use these options, you should consider whether there are economic incentives or disincentives, such as favorable or unfavorable lease terms compared to the market, costs related to termination, relocation, or abandonment. You should also consider the history of the lessee or the lessor exercising options to extend or terminate, and we should consider the extent to which the underlying asset is essential to the government. So now we've discussed all of the information needed to determine the initial amount of the lease liability. We have the costs to include, and the discount rate and the lease term in order to calculate the present value of those costs. Now the measurement of the lease asset starts with the amount we just determined for the liability, plus payments made to the lessor at or before the commencement of the lease term, and other initial direct costs necessary to place the asset into service. So that's it for the asset. The liability portion took up the big chunk of the calculation, but as you can see, the asset may not necessarily equal the lease liability. And let's summarize what we just covered for the lessee accounting and touch on the lessor accounting. The lessee will initially record an intangible right-to-use asset and a lease liability. The lessor will record a lease receivable and a deferred inflow, which will be the amount of the receivable plus any upfront payments received. The measurement of the receivable is similar to, but not exactly the same, as the measurement of the liability that we just calculated for the lessee. So if you are a lessor, I encourage you to review the measurement criteria in the standard to see which costs should be included in that calculation. In subsequent periods, the lessee will amortize the intangible right-to-use asset over the shorter of the lease term or the estimated useful life of the asset, and will reduce the lease liability by actual cash payments after interest to the lessor. The lessor will amortize the deferred inflow over the lease term using the straight line method, and will reduce their receivable by the actual cash payments received. Now, there are a couple of specific situations where our current accounting will likely change. And the first is short-term leases, which are those where the maximum possible lease term is 12 months or less. And this is determined using the same guidance to calculate a lease term that we used in calculating the liability. So if a government has a 12-month lease with an option to extend for another 12 months, and it's reasonably certain the government will exercise that option, the lease does not qualify as a short-term lease. If you do have a short-term lease, the lessee will simply recognize expense with each payment to the lessor, and the lessor will recognize revenue with each payment from the lessee. The other situation where our accounting will change are contracts where ownership of the asset is transferred at the end of the lease and there are no termination options. If an agreement contains a fiscal funding clause, and it is reasonably certain that the cancellation clause will not be exercised, the contract should still be treated as an ownership transfer. And in this situation, the lessee should consider the transaction a financed purchase of an asset, and the lessor should record a sale of their asset. So the transition to apply this statement is required for reporting periods beginning after December 15, 2019. For our June and September year ends, that would be fiscal year 2021. This statement should be applied retroactively by restating the financial statements for all periods presented. And when calculating your restatement, you should use the facts and circumstances that exist at the beginning of the implementation period. Now, as I mentioned earlier, this was a pretty big standard, and we only went through a high-level overview here. This standard also provides guidance on disclosure requirements and accounting for special situations, such as contracts with multiple components, lease incentives, contract combinations, lease modifications and terminations, subleases, sale leaseback transactions, lease leaseback transactions, inter-entity leases, and leases with related parties. In addition, the standard addresses remeasurement of the liability and lease asset if there are significant changes to the lease agreement, lease term, or if the asset is impaired. So that's a lot of stuff that we didn't cover here today. And if you have these special situations, I strongly recommend that you refer to the standard or again to your friendly Cherry Bekaert auditor. So let's take a look at this next polling question, which also asks, what impact do you think Statement 87 will have on your entity? Major, some, minor, none, or not sure yet? Okay, it looks like the numbers have stopped climbing, so let's go ahead and close out that poll. Again, some is the highest level here. We have 40% of people saying some, and there are a significant number that say major, and I do think that is going to be true. So make sure that you guys look at that early. We don't want to wait until the auditor is showing up in the year it needs to be implemented. Okay. So our next topic is GASB Statement number 88, Disclosures, Direct Borrowings, and Direct Placements, which was issued in March 2018. When the GASB was performing their research related to this topic, they found that the users of the financial statements felt that they weren't given enough information to determine the true risk to governments who had taken on debt. And they also found that financial statement preparers were not applying the current standards consistently in order to determine what constitutes debt as it relates to their financial statement disclosures. So the GASB issues this statement to establish additional financial statement note disclosure requirements and to define debt for purposes of disclosures in notes to the financial statements. The definition of debt is a liability that arises from the contractual obligation to pay cash or other assets that may be used in lieu of cash in one or more payments to settle an amount that is fixed at the date the contractual obligation is established. The term fixed is not meant to preclude cases where interest is accrued and subsequently paid, such as interest on variable rate debt, or cases where interest is added to the principal amount of the obligation, such as interest on capital appreciation bonds. Those issuance types are still considered debt for disclosure purposes. Accounts payable and leases, however, are excluded from this definition. The new disclosures required include the amount of unused lines of credit, assets pledged as collateral for debt, debt agreement terms related to events of default or termination events that have finance-related consequences, and debt agreement terms that allow for subjective acceleration of repayment. This statement also requires governments to separate information in debt disclosures regarding direct borrowings and direct placements from that of other debt. And a direct borrowing is debt that has been negotiated directly with a lender, and direct placement debt is debt that has been negotiated directly with an investor. In both of these cases, the debt is not offered for public sale. The transition to apply this statement is required for reporting periods beginning after June 15, 2018. For our June and September year ends, that's going to be fiscal year 2019. The statement should be applied to the notes to the financial statements of all periods presented. Next, we're going to discuss Statement 89, accounting for interest costs incurred before the end of construction period, and this was issued in June 2018. The objective of this statement is only to simplify the accounting for interest costs, and simple this statement certainly is. It's a 19-page standard, but it essentially just boils down to expense all interest costs incurred before the end of a construction period. That's it. There's no more capitalized interest, not in the business type funds, not the government-wide statements, definitely not in the governmental funds. That would have been incorrect under the previous guidance. This one gets it better. You can apply the standard as early as you like, and it gets applied prospectively. All you have to do to implement this standard is stop capitalizing interest. And while you can apply the standard as early as you like, it must be done no later than your reporting period beginning after December 15, 2019. So again, for our June and September year ends, that's going to be fiscal year 2021. The last standard we're going to discuss today is GASB Statement 90, Majority Equity Interests, which was issued in August 2018. So when Statement 72 on fair value measurements was released, the GASB received several requests to clarify whether a government reporting a majority equity interest in a legally separate entity should apply the Statement 72 or continue to apply the guidance in Statement 14. And this statement is issued in response to those inquiries and clarifies the proper measurement and reporting of majority equity interests. The GASB determined that majority equity interests in a legally separate organization that are held by a government and meet the definition of an investment as provided in paragraph 64 of Statement 72 should be reported using the equity method as provided in GASB Statement 62. Now, as a reminder, an investment is defined as an asset that governments hold primarily for the purpose of profit, and has a present service capacity based solely on its ability to generate cash or be sold to generate cash. Essentially, if a government is holding the interest to generate income, it falls into this category. If the majority equity interest is held by a government and does not meet the definition of an investment, then the interest should be reported as a component unit. However, if the interest is held specifically by a fiduciary permanent or endowment fund of a government, or by a special purpose government engaged only in fiduciary activities, then the interest is reported as an investment measured at fair value. So the transition to apply this statement is required for reporting periods beginning after December 15, 2018. For our June and September year ends, that's going to be fiscal year 2020. This statement has a split application depending on your situation. If the majority equity interest is reported as a component unit, this statement should be applied prospectively, whereas the other reporting methods should be applied retroactively by restating the financial statements for all periods presented. So we've made it through our GASB standards, and now we just need to look at the exposure drafts and projects that GASB has in the works. But first, let's do our final polling question. How closely do you monitor GASB's agenda? Very, somewhat, or not at all? Okay, we still have people voting, so let's give them another few seconds here. All right, it appears our numbers have stopped climbing, so let's go ahead and close out that poll. Looks like somewhat is the most popular answer here. Not at all is followed next, so hopefully you're listening. I mean, if you're listening to this, you're following a little bit. And we have about 17% of people who are very interested in what the GASB is doing. Okay, so on to the GASB projects. The GASB is in process of drafting a concept statement to define recognition criteria for whether information should be reported in governmental financial statements and when that information should be reported. This project has come about because in current practice, the board often relies on the conceptual framework of other standard setters, which tends to place too much reliance on accounting concepts that were not developed for a governmental environment. Research on this project began in 2005, and a first draft of the proposed concept statement is currently expected in February 2020. The GASB is also examining the financial reporting model, which is expected to impact several areas of the financial statements, including the MD&A, fiduciary fund financial statements, budgetary comparisons, the government-wide financial statements, specifically the format of the statement of activities and whether a statement of cash flows for governmental activities should be presented. And there's much, much more to that project. So this one could have quite an impact on our CAFRs when it's released, but it should only really affect the year of implementation, and from then on, we will just have to proceed with a new norm. This project has been in the works since 2013, and the GASB is currently in the process of reviewing comments received in the preliminary comment period. Based on the current work plan, a final statement is expected to be issued in 2022. Revenue and expense recognition has also made it to the GASB projects list. In this project, the GASB hopes to develop a comprehensive application model for the classification, recognition, and measurement of revenues and expenses. This project was partially prompted by the GASB's ongoing conceptual framework project, and partially due to the fact that certain common exchange transactions are not currently addressed in GASB literature. This leads governmental entities to again rely on the guidance of other standard setters. As you know, the FASB has recently issued their revenue recognition standard, and the GASB is using this opportunity to consider whether a performance obligation approach, similar to what the FASB has implemented should be included in governmental guidance. The research on this project began in 2015, and a first exposure draft is expected in 2021. And last on our list is GASB's re-examination of the guidance in interpretation number 2, disclosure of conduit debt obligations. This project will consider whether improvements to the interpretation is necessary due to the diversity in current reporting between governments and due to the effects of their current conceptual framework project. This project is nearing completion. The GASB is reviewing comments to the exposure draft, and a final statement is expected sometime this month. In addition to these projects, the implementation guide update for 2019 was issued today, so you can check it out on their website. It is hot off the digital presses. So that's it for our presentation today. My email address is on the slide again if you need it for questions. We made it with exactly 10 minutes to spare, so I can see if I can take a look at some of these questions some of you might have entered in for us. Now, I will only answer the ones that I know for certain. I will try to email people that I need to look back at the answer for. I definitely do not want to give misinformation out here, so I'm going to make sure that I know the answer before I say anything. We have a few questions about technical problems, so let's skip through those. Okay, will lease liabilities be considered debt for financial reporting purposes? No, leases are excluded from the definition of debt. Is there a FASB statement similar to GASB 89 where interest is no longer capitalized? No, there's not. That is going to be something that is different about governmental accounting. Yes, we did have a typo in our question, or somewhat. Okay, we have a question about a transcript being available. That would be a question that our learning department will have to look into for you guys. I will get to all of these other questions via email, and you should hear back from me, I would say, by Monday. I'll take a look at those. Learning department will send me your questions. So I will pass it back over to Morgan.
Yes, thank you all so much. The slides are available in the handouts pod, so you can just click on that tab and you can download that. You can save it on your computer. The recording will be posted. It takes about a week for that to go up on the cbh.com website. And in a little bit, you'll receive an email with an evaluation. We always appreciate your feedback and love to hear your thoughts. Thank you all.